Hey everybody, we are going to talk about a really unique real estate company I've had in my portfolio for a while that a billionaire wants to buy in its entirety, um, preferably sooner rather than later. So before we dive in, please take a minute and check out the link you see on your screen, fool.com/Frankel. Get the top 10 stocks to buy right now from my sponsor, The Motley Fool. It's the best way to support this work I'm doing on YouTube. Again, fool.com/Frankel, and please click subscribe to my channel if you don't already. I keep up with a lot of real estate and financial companies, especially. I cover personal finance topics like Social Security, and I'd love to have you keep up with all my content. So let's dive right in. The billionaire I'm talking about is Bill Ackman. He's very well known, big presence on Twitter or X or whatever you want to call it right now. But he is looking at a company that he already owns a lot of. It's called Howard Hughes Holdings. Ticker symbol is HHH. It's one of the larger investments in my portfolio. It's not my biggest, but it's definitely a top 10 holding for me. Really interesting business. Let me get into it real quick. I'll share my screen. Okay, so if you're not familiar, Howard Hughes Holdings, they're a developer of large-scale master plan communities or MPCs, but not what you would normally think of as a master plan community. I mean, my community has 220 houses in it and was called a master plan community when they were building it. It's really not. These are more like small cities than you would normally think of as just a community. If you've ever been to the Woodlands in Texas, that's an example of a Howard Hughes master plan community. Summerlin in Las Vegas, which people think is like its own city, it has its own downtown area and everything. That's a Howard Hughes developed master plan community. There are a handful of these in the United States, in the continental United States. There's also one in Hawaii. The Ward Village condominium development is a Howard Hughes project. There's a lot of these. There's one in Arizona that's just getting started. They spent $600 million and bought 37,000 acres of land near Phoenix, where they're going to develop a whole new one from scratch. That's getting started right now and is really excited. So the company describes itself as a real life version of the video game SimCity. And that's really the best description I've heard of it. It has an ultra long-term focus, which honestly is a turnoff to a lot of investors. So the general business model is think of this Phoenix community that I just mentioned, 37,000 acres. The business model is to gradually take a piece of that land and sell it to residential developers. Those developers will build homes and neighborhoods that will create demand for commercial amenities. Just as a simple example, if you have a neighborhood like mine with 200 homes, maybe there's a need for a gas station and convenience store out front. That's a commercial property. That's a very small example. Maybe there's a need for a little office building. But Howard Hughes will build those, hold on to them, generate rental income for itself, and use that rental income to build more properties. The presence of those commercial amenities, retail stores, offices, etc., makes the surrounding land inherently more valuable to home builders, so they sell off a little bit more. The builders create some more homes, and they build even more bigger amenities, things like that, like a shopping mall maybe, or something like that, or a hotel. And this value creation cycle continues, and in a community the size of a small city, this process can take many, many, many years or decades. In the case of the Phoenix community, it's estimated it would take about 50 years for that to really be built out. But being able to control the supply of land to that extent in a city-sized area is a massive advantage when it comes to long-term value creation. So because of this ultra long-term focus, you buy a plot of land in Phoenix and you tell your investors this is going to take 50 years to fully pan out. The market has a tough time valuing the company because of it. And not only that, a few different things have weighed on its valuation lately. The real estate market slowed down. That's made land sales slow down in a lot of cases. The high concentration of office properties are in that portfolio. I mentioned they build commercial amenities. They have a lot of office and retail, which valuations have dropped significantly over the past couple of years. So those have weighed on the stock price. The stock price has been a disappointment to investors. I've been an investor in Howard Hughes for a while. I'm essentially break even on the stock, and I've owned it for about 10 years. So it's pretty much been dead money in my portfolio for 10 years. I'm not going to sugarcoat that. And it was up quite a bit, but the recent real estate market and economic conditions have, kind of made it take a turn for the to the downside. And so, where does Bill Ackman come in? So, Pershing Square, Bill Ackman's hedge fund owns about 37% of Howard Hughes today. That stake has increased over the years, but Ackman's been a big holder since the beginning. The company was spun out from General Growth Properties in bankruptcy in the wake of the financial crisis, and Ackman was kind of led that. He was formerly the company's chairman until recently, and recently it's been confirmed that Ackman is weighing a bid to take the rest of the business private, essentially buy the 63% of the shares that he doesn't own. So he's considering making an offer. Howard Hughes has formed a committee to evaluate any offer. We don't know if anything's come in yet, but that's where we stand right now. And Bill Ackman was going to start a brand new investment vehicle, a new closed-end fund. That kind of fell apart. It's supposedly still in the works, but it got taken off the table for the time being. So this is kind of the replacement project, it seems, for right now. He's always loved this company. Loved the model, thought it could be a big value creation model over the long term. And if you look at just kind of the sum of the parts valuation, so it's not hard to see why he likes this. So I mentioned it's declined in value quite a bit, and not just the stock price, the inherent value of the assets has. You can see right here the estimate that they did like this in 2021. This is 24% lower than it was. But keep in mind, so this is about a $75 stock as I'm recording this. This is where they see the sum of the parts valuation. And since this presentation is made, this was the 2023 investor presentation, we should see a new one pretty soon. The Seaport, the New York City Seaport was one of their assets. That business has been spun off separately. You can actually buy that as its own stock, as its own publicly traded company. Seaport Entertainment Group, SEG, I believe, is the ticker. So we have to back out this $20 a share in estimated value. But if we do that, even if we take out that $20, that gives us sum of the parts total after debt, which is what this is, of about $109 a share. So if the stock's trading around $75, the intrinsic value of the business is about $109. Conservatively, this is designed to be a conservative analysis. It's not hard to see why Ackman might be eager to get the rest of this in Pershing's portfolio. So here are the possible outcomes as I see it. So number one, the most likely outcome I see is that Ackman is going to offer a modest premium to the current stock price, which is around $75. I would expect an offer to come in the $90 to $100 range. Anything more or less than that, I think anything less than 90 should just be rejected outright. And anything over 100 would surprise me. Like I said, the company's latest valuation estimate gives about $109 a share. So my preference would be for Howard Hughes to stay public. I feel like the falling rate environment will be a big catalyst for those property values I mentioned, for land sales. Just a really good thing for its entire business, and its intrinsic value should go up quite a bit as rates fall, which is another thing I think Ackman has on his mind. I would prefer the business to stay public, but if an offer came in at about $100 a share and the management accepted, I wouldn't be that upset. I'd love to hear what you think about it, the business in general. If you're a shareholder, what you're hoping happens. Please click subscribe to my channel again if you don't already. And thanks for listening. I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment. So I'm proud to partner with The Motley Fool to bring you 10 stock picks from the popular product Stock Advisor. Stock Advisor has beaten the market by nearly 5 times. So go to fool.com/Frankel to get your 10 stock picks now. The Motley Fool Stock Advisor returns are 767% as of July 5th, 2024, and are measured against the S&P 500 returns of 163% as of July 5th, 2024.